Good afternoon, ladies and gentlemen. Let me welcome those of you who are here in the room, as well as those of you who are viewing this session today by live webcast, web streaming video, something that we're trying to do to extend the reach of the presentations that will be presented today. My name is Wayne Abernathy. I'm the Executive Vice President for Financial Institutions Policy and Regulatory Affairs at the American Bankers Association, and I'm very honored to be the chairman of the Executive Committee of the Financial Services and E-Commerce Practice Group of the Federalist Society. It's a great privilege to work with the tremendous experts that are part of that practice group. But I also would extend to you, please do contact me if you would like to be more involved in the activities of our practice group, the Financial Institutions and E-Commerce Practice Group. See me afterwards or send me an email. Love to have you more involved. The more people that are involved, the more that we can know what we're talking about and reach the things that other people are interested in those areas as well. Today, the law that we're going to be looking at and that we'll be examining today, the Community Reinvestment Act, it may be the shortest banking law in the entire federal statute of the banking laws. It counts as 8 pages if you include the 3 lines that are on page 8. Its guts, well, that's the heart of CRA. Its guts are to be found in the regulations. And that's what we're going to look at, because that's what we're going to have the panel discuss today, because the regulators have put on the agenda reform and update of the CRA regulations. And it's time, they say, for us to bring them up to date to where they are, and in their view, more fully fulfill the intent and purpose of CRA. And that's what our panel is going to be discussing today. Let me introduce the moderator of our panel today, the Honorable Judge Joan Larsen, Judge of the United States Court of Appeals for the Sixth Circuit. She was appointed to this position by President Donald Trump and confirmed by the United States Senate in 2017, prior to her appointment to the federal courts. Judge Larsen was a justice on the Michigan Supreme Court. Judge Larsen will introduce the members of our panel. Please join me in welcoming Judge Larsen.
Hi, I'm delighted to be here today. My name is Joan Larsen, as you just heard, and I am a judge on the Sixth Circuit. It's an interesting, I don't even think it's a coincidence, it's an interesting, I guess I'll say coincidence that I am here to speak to the Financial Institutions Practice Group. I have a bank. That might be what I know about banking law. So I am very interested to learn from our distinguished panel today. I will briefly introduce our speakers, but I won't dwell long on their biographies. They're all available to you in the program and on the app. I will give everyone 6 to 8 minutes to make their opening remarks, because we want to leave plenty of time for discussion between our speakers, and then ultimately to open the floor to you to ask the questions that you might have. Also, just a public service announcement to please remember to turn off your cell phones or other devices. We're being live streamed, so you don't want to be that guy. Okay, our first speaker today is Keith Noreika. Keith is a partner at Simpson Thacher's Washington, D.C. office and a member of its Financial Institutions Practice Group. As the practice group name implies, his practice focuses on banking regulation and litigation, and he was previously the acting comptroller of the currency. So I am confident that he knows a great deal about the banking system in the United States. Next, we have Deepak Gupta. Deepak is the founding principal of Gupta Wessler, PLLC. He is a renowned appellate advocate who argues frequently in the U.S. Supreme Court as well as federal courts around the country. Before founding his firm, Deepak was senior counsel for litigation and enforcement strategy at the CFPB. Next, we will hear from Bert Ely. Bert is a principal at Ely Company and a well-recognized expert on financial institutions. He has a wealth of expertise in the banking industry, having specialized in deposit insurance and banking structures for more than 35 years. He consults widely and has helped draft numerous pieces of federal banking regulation. And last, we will hear from Jesse VanTol, CEO of the National Community Reinvestment Coalition. Jesse has spent a decade at NCRC and has played a key role in many of the organization's successful community reinvestment campaigns. He's also been instrumental in NCRC's efforts at housing finance reform. Gentlemen, we are delighted to have all of you here today, and we will start by hearing from Keith Noreika.
All right, well, thank you, Your Honor. It's a pleasure to be here today. I was tasked by my panel members with giving a little bit of a background of the CRA to bring everyone on the level and sort of where we are today, how it's enforced, how it's assessed, and what the current issues are. So just to take a brief quick trip through time, the Community Reinvestment Act was enacted in 1977. It was meant to address an issue of so-called redlining, if there were, that banks would stay out of certain areas or wouldn't lend within certain areas of their community. It was one of a number of laws passed in the late 60s and during the 1970s, such as the Fair Housing Act, the Equal Credit Opportunity Act, and the Home Mortgage Disclosure Act of 1975. At the time of the CRA's passage, the law's purpose generally was understood to require federal banking regulators to assess depository institutions' lending performance in their communities, with an emphasis on learning how such institutions were serving their local communities' credit needs consistent with the institution's continued safe and sound operations. The CRA's purpose talks about Congress finding that regulated financial institutions have a continuing affirmative obligations to help meet the credit needs of local communities, and encourages regulated institutions to help meet the credit needs of local communities in which they're chartered, consistent with safe and sound operation. Because of that broad language of the so-called obligation of the statute, many initially assumed that CRA obligations were merely hortatory to depository institutions, that Congress expressed the belief that to the extent CRA caused institutions to make additional loans or other banking services available to their local communities, institutions would be able to do so profitably, and it was not intended to alter the economics of banking, much less to convert depository institutions into public utilities. When CRA was initially enacted, Congress did not mention race or gender as criteria on which depository institutions should be evaluated. It was only in 1992 that Congress added two sections to the CRA that permitted the consideration of race and gender of CRA beneficiaries in limited circumstances when assessing a firm's CRA performance. It wasn't until 1999 in the Gramm-Leach-Bliley Act that Congress extended the reach of the CRA by requiring that in order for a bank holding company to become a financial holding company and thus able to engage in a broader range of financial activities, all of the company's subsidiary or depository institutions had to score satisfactory or higher. Over time, the bank regulators have come to view CRA as imposing a substantive obligation on depository institutions, and now they routinely enforce it through their approval process for various types of regulatory applications. In this process, commenters have the ability to comment on certain transactions that need regulatory approval. And they look at how a bank's performance is scored in its so-called community. Communities are measured by reference to metropolitan statistical areas and other geographies as defined by the Office of Management and Budget with regard to census tracts and the like. Obviously, these measures of community are delineated for purposes other than the CRA, and that has the potential these days to provide, have perverse effects on the working of the CRA. For instance, banks may want to stay away from certain geographies where they know if they do it there, they may have more lending obligations and make it harder for them to engage in certain transactions. CRA evaluations are done, as Wayne said, now under a set of rules issued by the federal regulators, and there are three tests that regulators look at: a lending test, an investment test, and a service test. Each is separately scored on a scale of outstanding, satisfactory, needs to improve, or substantial non-compliance. The institution's also given an overall CRA rating on the same scale that reflects a weighted average of these three tests. The lending test is the most highly weighted of the tests and looks at banks lending to its community, especially low and moderate income individuals within the certain geographies that are defined as its community for purposes of the Community Reinvestment Act. The investment test measures an institution's investment or money donated to community development in its assessment area, and the service test measures the institution's distribution system for delivering retail banking services in its assessment area. The evaluation process, I think is an understatement, exercises considerable judgmental discretion of regulators in making the evaluation, and there are no clear metrics or benchmarks for meeting a CRA requirement, even when activities, even what activities would constitute credit for purposes of meeting the CRA. CRA performance is also often judged relative to competitor banks operating in a particular assessment area, and a relative assessment among institutions can cause competition for CRA creditable activities, which can drive those activities from being profitable to not profitable. The federal banking agencies have also engaged in a process of so-called downgrading institutions for purposes of consumer compliance violations. One of the reforms I put in place when I was the acting comptroller was to limit those downgrades so that the consumer compliance violations have to have a so-called logical nexus with the firm's CRA creditable activities for which they're claiming credit under the various tests, usually the lending test. CRA reports are public. After an examination, the federal banking regulator must prepare a written report assigning a CRA rating to the depository institution and explaining the reason for that rating. Depending on the size, those institutions may only be rated every 3 years, so there can be a lag in activity. It's enforced, as I said, through the application process. Those are getting a new charter, getting deposit insurance, opening a new branch or moving a branch, or a big one is mergers and acquisitions. The only penalty is a potential failure to get regulatory approval. It can't be enforced through a court action, at least courts have said that. And under the current CRA regulations, federal banking regulators are supposed to take into account views expressed by interested parties, including community and local activist groups, when deciding whether or not to grant an application. The latest thing, and then I'll pass it along, is the OCC has issued an advance notice of proposed rulemaking in August 28th of this year. Comments are due next week, so if anyone's so inclined after this panel, you can go run and prepare one. But the advance notice of proposed rulemaking seeks to address some of the perceived weaknesses in the CRA evaluation process, making it clearer with clearer metrics of how to evaluate banks. So they can be judged across one another, and there can be more safety and security for banks in knowing what activities they take to meet their obligations. Again, that's just an advance notice of proposed rulemaking. It hasn't yet been joined by the other agencies enforcing the CRA. Those would be the Federal Reserve Board and the FDIC, although I assume when they get to the notice of proposed rulemaking, they'll have some kind of more of agreement between the agencies. So I'll stop there.
All right, thank you. Next, we'll hear from Deepak Gupta.
Great. Thank you, Judge Larsen, and thanks to the Federalist Society for having me here. The last time, if you'll permit me a small personal note, the last time I spoke at this convention was a week after the 2016 presidential election, and it's sort of the last room I wanted to be in. A friend called me and told me I should just call in sick. Why would you want to be around those people? But I realized I wanted to be here, and it's not just the spirit of open debate, that you really do want to hear from all sides of an issue. It's also that you're a group of people that care about the rule of law at a moment where it's really facing unprecedented threats. So I'm even more pleased to be here now this week after hearing about the formation of the Checks and Balances group aimed at rallying around our shared constitutional values, and I hope many of you will join it and speak out. I want to talk about the Community Reinvestment Act from the perspective of what I think are our shared constitutional values. Now, I'm a consumer protection lawyer. I worked in the last administration on consumer protection, and I think in an interesting way, the debate about this kind of sleepy law, I think a lot of people have not heard about this law, it doesn't get litigated in the courts, but it intersects in important ways with a big debate that our society is having about predatory lending, high-cost loans, payday loans. And I think there are some shared values that I hope can guide everyone's thinking about this debate. Because I think the real policy momentum, I want to just get this out, comes in part from an attempt by banks to get credit and therefore to incentivize so-called simple loans or other high-cost loans. And these are very high interest rate loans that actually compete with payday loans but are being offered by banks or through arrangements with chartered banks. So the first principle I want to get out there is let's ask about democracy and democratic legitimacy. If we're really talking about changing the CRA, and I think there is consensus that the statute is pretty outdated. It's as old as I am, and there have been a lot of changes in technology and banking since that time. But if we're talking about changing it as opposed to interpreting it, should we really be doing this through unelected bureaucrats, or should we be doing it through the democratic process? And just to give you some context, when you're talking about high-cost loans, I am worried that federal regulators will say through the CRA process that these loans are good for consumers and they should count. Banks should get credit for extending some of these high-cost products. But whenever you put the question of usury caps for high interest rate loans up on the ballot, when there are ballot initiatives about them, they pass by overwhelming margins. I'll give you a few examples. In Montana in 2010, the electorate approved a 36% interest rate cap with 71% of the vote. In South Dakota in 2016, the same kind of cap passed with 76% of the vote. And then in the most recent election last week, Colorado passed a ballot initiative with 77% of the vote. These are all 36% interest rate caps. There are 15 such ballot initiatives. They don't lose. And so if you're asking, are these loans good for consumers, I think you ought to pay attention in a democracy to what the electorate says at the ballot box, and also what consumer groups and community groups say about these loans in the affected communities. They don't think these are great loans. So I mentioned, South Dakota is one of the states that passed that ballot initiative. Just to give you one example of what's happening on the ground, there is a small Utah chartered bank called OppLoans. It's selling loans right now with a 199% APR. That is usury territory by any definition. Those are loans that compete with payday loans. And they're selling these loans in South Dakota. And that's plainly illegal under the ballot, the cap that was just passed by ballot initiative. But this bank says the loans are being originated by an FDIC member bank. And so you can see this effort to use the shield of federal regulation to shield conduct that would otherwise be illegal under state law. And I'm quite concerned that through this CRA process, but also through a number of other regulatory processes that are going on across the banking regulatory agencies, that the regulators will bless practices that are clearly not acceptable to the public when tested democratically, but will do so through this bureaucratic process that unfortunately is not very visible. You don't see a lot of people hotly debating the Community Reinvestment Act or other regulatory reforms. They're kind of happening under the radar. So that's the first test I want to submit, that we should ask about democratic legitimacy. Second, and closely related, federalism. Is there a role for states' rights or local control here? If you have these caps being passed on the ground, responding to local conditions, and you have a history here of states passing these kinds of usury caps, isn't there some role for the states? And then finally, the role of tradition. Restrictions on the rate of interest are probably the oldest and most ubiquitous form of economic regulation. They go back to every ancient civilization. They're part of the Bible. And we had them in the United States from the founding of the Republic up until the 1980s, where through a series of Supreme Court decisions and some deregulation, we effectively got rid of interest rate caps. And I think that tradition should count for something. And I think it's important to recognize that that deregulatory move happened after the CRA was passed. And so, I think you're probably going to hear broad consensus from the panelists that the assumptions on which the CRA rests are outdated. And I actually agree with that. But I think one way in which they're outdated is that the Community Reinvestment Act was passed at a time when policymakers regarded the extension of credit as an unalloyed good. The problem was redlining, right? You had banks that through geographic arrangements were not reaching minority and poor communities. And the problem that Congress principally wanted to address was to ensure that banks wouldn't do that they wouldn't exclude people from the extension of credit. But the story has completely flipped. And in the past decade or more, what we've really been worried about is the extension of high-cost products that trap people in a cycle of debt. It was that kind of extravagant lending that contributed to the financial crisis. And so that is an assumption that is outdated. And I think we should have a debate about that. But it's my submission that we should have a debate about that that takes into account concerns of democratic legitimacy, concerns about federalism, and concerns about the long tradition. I mean, if so many societies throughout history have organized themselves with usury prohibitions, have thought that this kind of high-cost lending is problematic, that probably should count for something. And I think that's one thing that conservatives understand, is that one reason to value tradition is that, we're not the experts on everything. Other people have thought about a problem and they may have gotten it right. And then finally, let me just end with a point of, I think, consensus. There is a real thrust to modernize the CRA because it rests on considerations of geography. And it used to be that every bank had geographic footprints and that was the right way to assess them. That just doesn't make sense right now for a lot of reasons. I mean, if you have Goldman is a state-chartered bank. Their headquarters is in New York City. They have lending centers in Salt Lake and in Dallas, and they're lending from all over the country. How do you assess them based on a geographic footprint? It doesn't make sense. So I think there's probably consensus among everyone that it's the actual interactions that financial institutions have with people that ought to count rather than simply geographic footprint. But I will say, and this is my final thing I'll say, in preparation for this, I talked to a friend of mine who his job takes him to community banks all around the American South. And he did point out that he hears over and over again that these storefront banks really matter, and their interactions with particular minority communities really matter. And I do think there is a real need among the poor and underserved communities for basic banking services, for no-fee checking, for credit cards that allow you to travel, simple banking services. And if the CRA is used as a mechanism to no longer give credit for that kind of basic banking, I think what you'll see is a greater push, and this is already being proposed, for postal banking, to have basic banking services at post offices, and query whether those of you who represent financial institutions, whether that's actually something you want to encourage downstream. Thanks.
All right, thank you. Next, we'll hear from Bert Ely.
Thank you, Judge. The Community Reinvestment Act, or CRA, now 41 years old, was enacted on the basis of premises which were questionable at the time, if not outright false. More importantly, the financial services world has changed dramatically over the last 4 decades. Many of those changes further undermine whatever premises might have existed in 1977 to justify the CRA. The time has come to reassess those premises on which the CRA is based and to reconsider its continued existence. Key to that reassessment is understanding how much the financial services world has changed over the last 41 years. Back in 1977, S&Ls were the primary source of mortgage credit. The largest portion of retail financial services were delivered through bank and S&L branches, with a balance delivered through credit unions, finance companies, mortgage banks, and captive finance companies. Third, branching prohibitions and restrictions in many states greatly restricted bank entry into new markets, which protected existing institutions, thereby limiting customer choice and disruptive entrants. Regulation Q interest rate limitations caused periodic credit crunches, particularly for home mortgages. Electronic banking and the delivery of banking services over the internet were unheard of. Redlining complaints were prominent in states with highly restrictive bank branching, such as Illinois and Texas. And finally, numerous laws already had been enacted to bar lending and discrimination, including the Fair Housing Act, Consumer Protection Credit Act, Equal Credit Opportunity Act, and the Home Mortgage Disclosure Act. Today, many of the constraints on the delivery of financial services have declined substantially or have disappeared, in part because of increased competition. Branching restrictions have been wiped away, as well as Regulation Q. The electronic delivery of financial services has exploded, with innovation continuing at a rapid pace. At the same time, enforcement of fair lending laws has continued unabated. Smart bankers, of course, have always realized that it's dumb to discriminate, because that means passing up on profitable business opportunities. Here's the question we should be pondering today. If the CRA had not been enacted in 1977, how different might be the financial history of the last 42 years? To the extent that CRA incentivized banks or compelled them to unwisely extend more credit or to loosen their credit criteria, was the 2008 financial crisis more severe than it otherwise would have been. Many have argued that CRA-driven lending preceded the financial crisis and exacerbated the effects of the crisis, in part because homeownership was overstressed. For many folks of modest means, owning a home, in fact, is often not a wise investment. Obviously, we can only speculate about alternative outcomes, but it is a useful speculation whenever changes in the CRA are debated. A more fundamental question, if the CRA had never been enacted, would enacting such a law even be considered today? I doubt it, but that is a debate worth having. Put another way, what are the pros and cons of continuing the CRA in any form? How might the financial services world change if the CRA suddenly disappeared, other than leaving lots of CRA examiners and bank compliance people they deal with looking for new jobs? Those questions have become more pressing as financial technology increasingly lessens the role of bank branches in the production and delivery of financial services, and specifically of credit products such as home mortgages. Let me suggest that we might actually see greater diversity in the types of firms providing financial services if banks were empowered to break away from the one-size-must-fit-all business model imposed on them by the CRA. No doubt we would see more minority-controlled banks serving minority communities, as large banks no longer felt compelled to serve arbitrarily designated assessment areas solely in an attempt to earn an outstanding CRA rating. While CRA repeal is not actively being considered this time, the recently enacted tax law, the Tax Credits and Job Act of 2017, has introduced a CRA-like provision that may force a fundamental reconsideration of the CRA, specifically as it relates to bank lending. The new law added a new section of the Internal Revenue Code called Opportunity Zones. According to the statute, qualified opportunity zone means a population census tract that is a low-income community that is designated as a qualified opportunity zone. These census tracts are essentially the ones that CRA is focused on. Favorable capital gains rules have been established for investments in opportunity zones. These investment opportunities, in turn, will generate lending opportunities for banks in those zones. There are limits on the number of opportunity zones that can be created and the types of qualifying investments that can be made in those zones. I suspect, though, that banks will seek to include opportunity zones in their CRA investment area because of the additional lending opportunities those zones supposedly will create. However, opportunity zones, when interacting with banks' CRA obligations, may create unintended and perverse consequences, notably wasteful and uneconomic investments in opportunity zones that eventually generate loan losses for banks while actually damaging a zone when an investment later goes bust, leaving behind empty structures and unemployed workers. And I might add, there have been several interesting articles in the New York Times in just the last couple of days about opportunity zones. Time will tell if this interaction between the CRA and the Internal Revenue Code is a success, or is more likely to be the case, backfires. I will close my remarks with some comments about redlining. A key premise justifying the CRA, even today, is the concept of redlining, that certain neighborhoods have been designated as high risk and therefore bankers should not lend in those areas. Redlining dates to the 1930s when the federally chartered Homeowners Loan Corporation, or HOLC, was created to refinance home mortgages and, when necessary, to foreclose on defaulted mortgages and sell the foreclosed houses. To assist in this undertaking, the HOLC examiners created color-coded, what were known as residential security maps for major cities, with 4 colors used to designate neighborhoods: green for the best, blue for still desirable neighborhoods, yellow for definitely declining neighborhoods, and red for so-called hazardous neighborhoods where property values were most likely to decline. Presumably the term redlining stems from the use of that color. After reviewing a map of the Cleveland, Ohio metropolitan area the HOLC created, I strongly question the extent to which racial considerations overtly played a role in how HOLC classified neighborhoods as to the degree of riskiness in making home mortgages. I grew up in Cleveland, spending my first 24 years there, including attending college and later working on public accounting assignments that took me all over the metropolitan area. Consequently, I knew Cleveland's geography quite well. Many of the areas colored red on the Cleveland map were in fact areas where property values were weakest for non-racial reasons. Many of the areas, in fact, were 100% white. Those areas were colored red, in my opinion, for one or more of the following reasons. The houses were old, small, and of wooden construction, and or they were adjacent to industrial areas. At that time, Cleveland had lots of heavy industry that generated lots of pollution. The city of Cleveland also did not have very good schools, another negative in value in residential properties. No doubt many of the red zones in Cleveland and in other cities the HOLC mapped were largely, if not entirely, minority communities, including immigrant communities. But I question the continued use of the term redlining in the context of its apparent initial use 80 years ago. If nothing else, many once red neighborhoods in cities across the country are now solid green due to gentrification, while other once red neighborhoods are improving in quality as more and more folks of all ethnic backgrounds value urban living. I certainly have seen that process in Alexandria, Virginia, where I have lived for the last 37 years. In closing, the discussion of housing patterns and credit availability as those conditions exist today should reflect today's realities, and especially the manner in which credit is now provided, and not the United States of 40 or 80 years ago. The CRA, should it continue to be law, should reflect current day realities. Thank you.
All right, thank you very much. And now we will hear from Jesse VanTol.
Okay, Jesse VanTol, Chief Executive Officer of the National Community Reinvestment Coalition. NCRC was founded in 1990 to save CRA, was an instrumental part of the mid-1990s reforms to CRA, an integral part of the conversation in the late 1990s around Gramm-Leach-Bliley. It's the first time, Keith, I've ever heard Gramm-Leach-Bliley as having strengthened CRA. I think it would be news to Senator Graham that was the case. There were some elements of it that weakened CRA as well, but we played a critical role in that and are very actively engaged in this discussion over CRA today. I'm going to sort of largely talk about the state of play, the ideas being proposed right now. I wanted to take a moment to comment on some of Bert's remarks, because I think sort of going back to the roots of CRA are instructive for today's conversation. Right now, nobody is looking at getting rid of CRA. The debate and the conversation is, how do we change CRA? How do we provide more clarity? How do we make it better? But certainly, I think some of the fundamental questions are important to discuss. So the first one's sort of the rationale, the reason behind CRA. We often boil it down to a single word, which is redlining. And redlining was a practice in which banks would draw red lines around neighborhoods and not lend there. It was codified in government practice and policy with the Homeowners Loan Corporation, in which neighborhoods were graded. I actually have an answer to some of Bert's questions. We did a study and we found that 75% of the neighborhoods redlined under that Homeowners Loan Corporation practice, 75% of them are today still economically distressed. So a lack of capital investment in communities over time is a self-fulfilling prophecy. Those neighborhoods struggle to do better over time. We also have an answer to the counterfactual. CRA has been difficult to measure because it involves proving a counterfactual. What would have happened if it didn't exist? And fortunately, we also have the answer to this question. The Philadelphia Fed did a study of census tracts in the Philadelphia metro area that lost their CRA designation essentially because of the census. They went from being lower moderate income to not being that way, to no longer being included in the Philly MSA for CRA purposes. And what they found, what they documented, was a 10 to 20% drop in lending in those communities over the next 3 to 5 years. 10 to 20% drop. That, by the way, I think is a very conservative estimate. And the reason is that the banks in those communities had built up an infrastructure to do lending. They had opened branches in those communities. They had fulfilled their CRA obligations. And those things don't just go away when a tract suddenly becomes not CRA eligible anymore. In fact, if anything, the increased economic activity in that community should be evidence of more lending. And it really only measures the geographic basis for CRA. Banks still get credit in those census tracts outside of Philadelphia for lending to low and moderate income people. So the fact that you see a 10 to 20% drop, I think, is significant. If you extrapolated that across the entire country, it would be $50 to $100 billion in home and small business lending that doesn't happen over the next 5 years. That is a significant impact. Again, I think it is a very conservative impact of CRA. And that's just really the lending test part of CRA. On investments, the largest banks in the country, the top 20 banks, do about $35 billion a year in community development investments. And some of these investments are quite profitable. Someone said, I believe it was Keith, that maybe banks compete for certain type of investments, drives up the price, makes them less profitable. That happens in the LIHTC, low-income housing tax credit area occasionally, but more than one bank has reported that that area of their business has been the most profitable line of business for their company in certain years. Some of that would continue to occur without CRA. I think much of it would go away in many communities outside of New York and some of the higher cost communities. So I want to come back to this redlining notion, though. That redlining is a word we use to describe a broader phenomenon, which is a lack of capital and credit access in many communities, including poor white communities. I would dispute the notion that race was not a part of CRA. Race was a part of the conversation, certainly when CRA was passed. Discrimination against people of color. Many of these laws come out of the civil rights movement. They are a suite of laws. They are related to each other. They interact with each other. But you know, you can find discrimination against poor white people as well. Many of the conversations by realtors at the time, even up to and including mentions within the FHA underwriting guidelines, ranked neighborhoods by ethnicity. It was really clear that ethnicity went into the grading of communities and their sort of relative desirability, and that includes the ethnicity of white people. So you know, there's a list that separated northern Italians from southern Italians, southern Italians being less desirable and part of those hazardous communities that the Homeowners Loan Corporation divided. The Irish were considered to be less desirable. Ethnicity was absolutely a part of redlining, and it didn't include just people of color, it included poor white people as well. And poor white people have always been a part of this notion. So CRA was established on a class basis. And I would put to you that today, when we look at that original problem, often sort of captured as redlining, but when we look at the problem of capital and credit access, it continues to exist today. The average credit score for Fannie, Freddie, FHA is higher than it's really historically ever been, in the 700s. Many people cannot get loans, and I think the evidence is that the impact of CRA, a 10 to 20% loss of lending in communities, justifies its continued existence. And I want to say, Deepak talked about shared values. People often forget that CRA, and in particular HMDA, which is really a companion law to CRA, was in part about transparency. It was about disclosing what institutions are doing to serve their community, letting the public know about that. And I want to make a point that when we think about market theory and we think about competition producing optimal outcomes for each side of the transaction, the assumption was also that there would be perfect information. And I would put to you that our system of capitalism over time has produced a scenario in which the people extending capital and credit have a lot more information than the people receiving it. There is a power imbalance in that transaction in which one party has not nearly as much information as the other party. And that is, I believe, a root of the kinds of abuses that we see in credit markets. Your average person might get a mortgage, I don't know, 3 or 4 times in their lifetime, maybe only once. But the average mortgage lender is going to make that transaction thousands, if not millions of times. And so HMDA CRA is in part a transparency law. The debate today around CRA is really about 3 things. It's what counts, where it counts, and then how we're going to sort of enforce and grade and get input around those factors. And on the, one major idea sort of pushed by the OCC is making CRA a more metric-driven approach, to bring a lot of clarity to sort of both what counts, but also sort of where it counts. There's an interplay there. And I think the idea that's received the most attention is the Comptroller Otting's idea around establishing sort of one metric to determine whether or not a bank is meeting its CRA obligation. And the one metric is a counting up of all of the activities that count for CRA, loans to low and moderate income people. They have some ideas about maybe broadening what counts. The industry has certainly pushed for that. Let's broaden what counts in the buckets. So you add that all up, and you divide it by some measure of a bank's capacity, some measure of what their obligation should be, and that's maybe assets or deposits or Tier 1 capital, different ideas for what that is. If it's above a certain ratio, you get a passing grade. That's the sort of the purest form of a one metric idea. And this is something that the Comptroller has mentioned, has brought up as a central idea in the reform process. And then sort of below that, sort of the state of play currently, maybe you can't have one metric. There's a challenge to sort of having one metric. The statute speaks of communities and measuring banks in communities. And in fact, Marty Gruenberg, the former FDIC chair, gave a speech recently in which he said, in fact, you can't have one metric. It's illegal. Because in 1994, Regal Neal added the MSA as the standard for the assessment area upon which banks would be measured. So now the notion is a sort of a metric-driven approach. Maybe it's not one metric. Maybe we'll measure banks sort of in MSA, but establish some metrics, establish some quantitative aspects of measuring bank performance. And this too has challenges. I'll point out that idea was originally proposed by the Clinton administration in the mid-1990s. It was withdrawn as part of the update to the regulation because banks and conservatives said it was credit allocation. They said it would distort markets. They said if you did that, either you set the number too high and banks can't meet it and it distorts what loans they make, or you set it too low, in which case it's meaningless. But getting exactly the right metric or exactly the right number is inherently difficult to do, which is why the regime was designed around performance context, around relative to peers, around what's happening in the market, and the core of CRA. And then I'll end, because I guess that timer was for me. The core of CRA, the intent of the law was always about the convenience and needs of the community. And one community is very different from another community in terms of what's going on. It inherently was designed to make sure that banking institutions, in the places that they are chartered, where they are taking deposits, that's the capital of community, that they are putting them back to work in those communities. And as they do that, they are assessing what is happening in the community. They are assessing what the convenience and needs are. They are assessing what the community needs, not just in a quantitative, metric-driven way, but in fact, qualitatively, what's different in Rochester, New York versus Memphis, Tennessee. What's different in this community, and being responsive to that, being responsive to those needs. And that is really the entire legislative history and core intention of CRA is to make sure that institutions based in community are responsive to those needs. So I disagree also with Deepak a little bit. I think you can't make it not geographically based. I think you can make it a blended system in which, depending on business model, a banking institution is really responsive geographically to the needs, but also to the needs of people and individuals.
Okay, thank you. So after warning everyone to silence their cell phones, it turns out I'm that guy. So I do apologize. If experience is any measure, I am guessing that the panelists have a few remarks that they'd like to make in response to things they've heard others say. So I'd like to give each of you just a few minutes if you have anything you want to say in response in part of the conversation, and then I will either ask some questions or see whether we have some coming from the audience. So, Keith, do you have anything that you want to say?
Well, sure. No, thank you. This has been a very informative discussion. I think at the end of the day, when we start to look back at the original purposes of the law, we've come a long way, and there are obviously vested interests that crop up in the sort of regulations and monitoring and enforcement of CRA that's come over the last 40 years or so. To me, having been a regulator, I thought the purposes were salutary, but the execution of it left a lot to be desired, both at the regulatory level, just trying to make judgments. It was not clear. I thought there needed to be a little bit more clarity, both for the sake of administering an agency, as well as who were the potential beneficiaries, and fairness to the regulated industry as well. And so I think that's a laudable goal of the current my successor at the OCC is to sort of move to more transparent means by which you can judge whether or not you've met the CRA, and frankly, maybe there should be some safe harbors or the like, so we don't get into protracted fights at the time of economically beneficial transactions, that you can know whether or not you've met it can be enforced potentially more in a supervisory manner and less as a sort of roving specter of liability over economically beneficial transactions.
So I'll make 2 points that sort of pick up on the themes that I was talking about and how I think they touch on what people have said. The first is, on the question I was stressing democratic legitimacy, right? Because we have these federal banking regulators. It's not just the OCC. I think it would have to be a coordinated effort by all of the prudential regulators to do something here. These are big questions. I think the discussion today shows you that there are competing values here, and we are talking about a law that was, I think, intended to be a civil rights law. Despite what we've heard, it was intended in part to address the credit needs of minority communities. And yet, there have been changes over the last 40 years that may necessitate an overhaul. And I think, what I heard from Bert was the argument that maybe Congress wouldn't have enacted this law today. And I think in our system, if you don't like a law, if you think that it shouldn't have been enacted or that it needs to be changed, we don't do that through unelected processes. We do that through the political branches. And I am afraid that we have here a situation where the changes that are being sought are changes that everyone knows could not be accomplished through the political branches. Not simply because you need expert regulators to do this, but because they would be extremely unpopular. And so if that's the case, that really raises fundamental questions about the democratic legitimacy of what the administrative state is trying to do in this scenario. And then the second thing I would say, and I don't want to be misunderstood, when I said that I think there are some outdated assumptions in the statute and that geography is no longer the be-all, end-all, I do think that's true, and I think the example of online lenders shows that most clearly, right? There were no online lenders in 1977, and with so many other things about the internet, it's challenging when you have a legal framework that was devised based on geography to figure out how the internet should be treated. So I do think there needs to be some updating for that. But I want to be absolutely clear. I mean, this is a law that recognized in 1977 something that is still true today, which is that in many communities, if there is no access to some kind of storefront banking with basic services like checking accounts or extensions of credit, that is going to be a very bad thing for those communities. And we know that what will happen in those communities is that if there aren't ordinary banking services, people will turn to check cashing joints and payday lenders that will trap them in a cycle of debt. That is more true now than it was in 1977. So that's a reason even more so to have standards like the Community Reinvestment Act. So I think, I'll just make a pitch again to ask yourself when you hear this debate, how do you think, if you answer it, if you ask yourself about core conservative principles, democratic legitimacy of the administrative state, federalism and local control, and the value of tradition, how do the things you're hearing stack up? I don't think that that what the OCC and other agencies are planning to do stack up very well against those metrics.
Could I just say one or two things in response to that very quickly?
Sure.
First, democratic legitimacy, I don't know, gets you very far here because all the obligations are put in place by undemocratically elected regulators. So if those regulators just repeal what they did, we go back to a world where none of this exists. So you can't hide behind democratic legitimacy to keep something that's undemocratic in the first place. The second thing is, on the payday lender front, it seems I sympathize with you, but certainly the things I've seen from inside the OCC was, by driving these people out of the banking system, I mean, you're sending them 199% interest rate is a lot better than, say, 1,000% interest rate. And by, there's still like the 26% of the people that didn't vote for that law who need some kind of cash somewhere and are going to get it. So, I don't think that really has much to do with CRA, at least in my view, unless it has something to do with creditable activities. But, you have to always worry about the perverse impacts of sort of what you're arguing for. So that's just, I don't mean to interrupt Bert. So.
No, that's good.
Or Jesse.
I was going to note that I wasn't quite sure whether I had just heard Deepak Gupta advocate the contraction of the Commerce Clause and the overruling of Humphrey's executor, but maybe, and so that's.
If I said that, I went way too far.
All right.
Lawyer jokes.
All right.
Again, I just want to come back to a point that I made before and others have touched on, and that is technology has really irreversibly changed the production and delivery of financial services. And the question is, does the CRA reflect that? Because what the technology has done is in many ways reduce the importance or the significance of geography, and hadn't eliminated completely. And a key question that has to be asked, particularly in terms of defining what are called assessment areas, is that still a valid way to look at the manner in which financial services, and particularly credit products, are being delivered? And I think that that's just not being acknowledged enough, that in effect geography, even though it's not unimportant, it's nowhere near as important as it was in 1977. But I think the other thing that has to be asked, that I touched on just very briefly, and that is, how has the CRA distorted the delivery of financial services? Now, let me give one example that I've heard on a number of occasions, and that is that what CRA does is it incentivizes the large banks, particularly those who want to be doing acquisitions, to go out and be so aggressive in lending in favored communities that it actually has led to an erosion, a disappearance of banks that were initially set up to serve those areas. In effect, banks set up to serve various minority communities. And I think that it's a complaint that I've heard, and it's one that I think has to be acknowledged as, shall we say, an unintended but still undesirable consequence of the CRA.
So let me try to sort of handle a number of things at once here. So undoubtedly the banking system has changed, and sort of our remedy for addressing that when it comes to assessment areas, when it comes to other things, is an acknowledgement that today banks, so not just fintechs, not just internet banks, but banks are increasingly driven by technology. They're taking deposits from places where they don't have branches. Notably, the original statute actually doesn't really define deposit-taking facilities. I've argued that this should be considered a deposit-taking facility. And on that basis, you could establish an assessment area wherever an institution is taking deposits, including through the internet. You could cover fintech-type companies that are taking deposits in that manner. But we have also argued for establishing assessment areas, not just on the basis of deposit taking, but also considering business activity lending, essentially. And there is some precedence for this even in the current framework. It might require to do this fully, a change to the law, but essentially you could set up a regime in which you are examining institutions, banks or otherwise, where they're doing concentrations of lending. And even when you look at fintech companies like, say, Square, you can find within the lending that they do, you can find within the activities that they do, geographic concentrations of where they're doing business. And that could be a basis for establishing an assessment area, an area in which they need to go deeper and try to solve some of the problems that CRA originally envisioned. I'll remind people that while the problems that CRA was set up to address, redlining, credit access, things that I believe continue to happen today, the rationale for applying the CRA obligation to banks was that they received deposit insurance and other forms of government subsidy. You think about access to the Fed window, et cetera. Other forms of subsidy, and so there was a quid pro quo. There was a rationale for applying a public policy obligation to them. I would argue today we know that the entire mortgage system in the country is backed by the federal government. The financial crisis taught us that. And if you want to disagree, $30 trillion in loans, investments, and guarantees were made at the height of the crisis, not just to banks. The federal government stepped in to make sure that the system didn't go under, and thank God they did. There was a very good reason to do that. It saved the economy. It saved probably millions of jobs. It would have been much worse. But the point is there's inherently a government subsidy standing behind the financial system, and we have throughout our history examples of when the financial system gets out of control and takes too many risks. It results in calamity, and so there is a reason a government infrastructure has been built up around that system. But that building up of that infrastructure is a form of subsidy. The rationale exists to expand CRA, to apply it to more institutions, to mortgage companies, to credit unions, something that we have supported. And I think if you were to ask the question, if the law were passed today, would people want to do it? I would say, if anything, people would go further today in passing a CRA-like law if they really understood what it did and what it meant. And to Deepak's point, be careful of what you wish for. The affordable housing crisis around the country, the rental affordability crisis, home ownership at a 50-year low, is leading to a resurgence of ideas like rent control, to a resurgence of let's regulate the banks and the financial system. That when you poll people, overwhelmingly, they are supportive of more regulation for financial services company. And I won't sit here and tell you that I think, yes, 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 more regulation is good. We take a very nuanced view on that. But I would say if you were to have the debate today and you were to look at what's happening in low-income communities, you look at what's happening in working-class white communities, people are struggling to get ahead, and inherent to our system of building wealth is access to credit, is being able to buy a home or start a small business. And I think, if anything, if people understood sort of this law and the nature of it, you would have a conversation that said, let's go even further in making that a requirement.
Okay, well, on that provocative note, are there questions that people would like to ask this panel? There's a microphone right behind you. If you can go to the microphone, I think it helps pick up.
If I could just make one quick follow-on comment. You know, in order to have that debate, what we should do is repeal the CRA, and then that will trigger the debate.
How about we have the debate
would.
and then figure it out?
You have to go to Congress for that. That's the problem, right?
Hey, I'd appreciate your opinion on whether the three following factors might justify a rollback of CRA and its regulations. The first would be Professor Todd Zawicki down at George Mason has determined that the subprime mortgages actually didn't default at a higher level than other mortgages during the financial crisis. So would that fact make you think that there is a market there that could be filled by financial institutions without the CRA, holding the club over their head? Second would be with regard to interest rate caps. If you do not allow interest rates to match risk, Mr. Gupta, is that going to limit the opportunity for low-income people to obtain financing for their businesses and their personal consumer loans? And then the third would be, if I can remember it here, I'll be like that guy yesterday that forgot what he was going to say at the end. And let's see. Well, I'll just leave it at those two. There are probably some other lurking variables out there that you might address, but that's what I'd be interested in knowing. So.
Perfect, thank you. Who wants to take those?
I just could quickly react, especially since one of them is directed to me. So on the first point, I think the scholarly consensus is not Todd Zawicki's view. The scholarly consensus is that, there's overwhelming consensus about this, right? Including the Financial Crisis Inquiry Commission conclusions that subprime mortgage lending was not the only contributing factor to the financial crisis, but was overwhelmingly a part of it. And the default rates were higher, and the securitization of subprime mortgages contributed to cascading effects that nearly brought the economy, did bring the economy to the brink of crisis. That's just, we can have a dispute about facts. That's not very interesting. On the second question, I think you're right that, and I think Keith said this too. You do have to be worried about the law of unintended consequences. And it is true that if you restrict credit too tightly, particularly when it comes to banks, that people will seek out, because people want the credit and they're desperate for credit sometimes. And I think this is where, folks like me maybe are a little bit more paternalistic than folks like people in this room. I think sometimes people don't necessarily have all the facts and know what might be best for them, and that's how they end up trapped in cycles of debt, things like payday lending. So you do have to worry about that. And I think even with the simple loans that I mentioned, so this is this product, US Bank has a product like this, I think it's like around 70% APR, I think there's a legitimate debate about whether products in that neighborhood are going to meet the needs of credit and prevent people from going to payday loans. So, I do think there needs to be a debate about that. What I've been suggesting is that these are big questions that involve competing value choices. They are not just questions that ought to be done under sort of the cover of darkness. We ought to have a public debate about that. So I think maybe Bert is right. If you don't like the CRA, The way you do that in our system is you go to Congress and let's decide as a society what we want to replace it with. And I think Jesse is right that if you had that debate, if people understood the stakes of the debate, we know this from the ballot initiatives, they would overwhelmingly favor tighter restrictions, particularly when it comes to predatory lending, which is, I really think, what this is ultimately about. There's a kind of a crypto debate that is ultimately about using the prudential regulators to bless and incentivize predatory lending that's otherwise illegal and increasingly illegal at the state level.
I just want to make two quick caps. First of all, rate caps are loved by loan sharks. The lower you put those caps, the more you incentivize illegal or undercover black market type of lending. And I don't think that is very desirable socially. It's better to have those who are operating within the legal system providing credit, even if it's seen as very costly, rather than trying to squeeze them out of existence. The other thing that is very misleading are these interest rates, like 70% APR. Particularly in small dollar lending, there's a lot of fixed cost. It costs probably as much to make a $500 loan, personal loan, as it does a $5,000 loan. And so the lender has to get a recovery of those costs in addition to paying for the cost of the funds they're lending. And I think that's certainly one of the most distorting aspects of this debate, is to throw around these percentages without putting them in the context of what the lender's costs to operate are.
So, on rate caps, I think it's a complicated issue insofar as, it's kind of a moral question and more of a legal one. I mean, I think the question is, if you sort of just do a comparison, isn't 100% better than 500%? Everybody would say, yeah, 100% is better. But there is sort of a larger question around just because there is a demand for a product, if it's inherently abusive, if it doesn't produce ultimately a real benefit to the consumer, and if it could be done at a lower price and still manage for risk, shouldn't that be the product that we sort of allow within the context of the federal banking system? And there are companies, there are credit unions, there are banks that do these types of loans at below 36%. The evidence would suggest that some institutions have figured out how to cover for risk and are able to do those loans. I think the real question is, how are they pricing it not for risk, but for their profit appetite? And I think that maybe in different situations, people are, seeking to make more of a profit or less of a profit. And so will you have enough liquidity if people can't make enough of a profit to sort of satisfy the needs of their investors, their shareholders, et cetera? That, to me, is the debate. It's not really about risk. There are institutions that are doing it below 36% and covering their risk. On subprime, yeah, I think the body of evidence is subprime, sort of the first wave of the foreclosure crisis did default at really significant rates. Subprime is sort of one of those words that has a lot of different definitions. It's a little unclear. You start to talk about Alt-A and other types of products that sort of layered risk, had a bunch of risky features. But just connecting to something that was kind of alluded to earlier, there was this myth, this story out there that somehow CRA motivated subprime lending, CRA motivated risky loans that caused the financial crisis. Everybody from the CEO of Bank of America to the Federal Reserve has said that's not true. The Federal Reserve did a study and found that 94% of those subprime loans that were risky were not motivated by CRA at all. If they were made by traditional banks, they were made outside of their CRA assessment areas, so they got no CRA credit for them. So the body of evidence is that CRA really had nothing to do with sort of the foreclosure crisis and the resulting financial crisis. I do think that some people discovered that there was money to be made at those types of products, that low and moderate income people actually were a good credit risk. And you saw, unfortunately, innovation within the private sector, the advent of certain types of mortgage-backed securities, the advent of synthetic CDOs, the advent of dangerous, really risky, really financial alchemy that was, created liquidity on steroids for the types of loans that nobody could verify whether the person could pay it back or not. And so you saw a loosening of credit standards. Has nothing to do with CRA, has nothing to do with creating home ownership for low and moderate income people, really has nothing to do with a public purpose at all. It had everything to do with unbridled greed and people wanting to make a significant return. And by the way, you don't have to believe me, the advocate on that. You can go to Lou Ranieri, you can go to industry. You can go to Republicans, Sheila Bair. You can go to any one of these people and they would tell you exactly the same thing.
Is she a Republican?
She is a Republican, yeah.
All right.
Yeah, she is.
It looks like, do we have another
Lifelong.
question here? Yeah. Yeah, no, please, come on up. And if you can say your name and
sure.
affiliation, I
Sure.
can ask.
John
We
Giocaris.
just see a bright light up here.
Yeah.
Fair enough.
Is it you, God?
I'm John Giocaris. I'm with the Chicago Federalist Society. This question may be a little broader than the scope of this panel, but I think everyone here is well qualified to answer it. For someone who's, not as familiar with, bank regulatory laws and whatnot, I kind of just wanted to ask a more broader question about what does Dodd-Frank exactly do? I think it imposes a lot of, transparency.
Do you have a few hours?
Yeah, I know. I'm sure that's a loaded question, and if that's too broad, I have a more specific one, which is I believe it was earlier this year. In an age where bipartisanship seems to be rare, there was a widely bipartisan law passed that kind of I think scaled back the reach of Dodd-Frank in terms of. I think if banks had less than $250 billion in assets, if I'm not mistaken, which was mainly community and small banks, the Dodd-Frank was widely scaled back, and I think they even passed with the bipartisan supermajority in the Senate. And again, in these days and age, it seems rare. But I wanted to ask a little more specifically about Dodd-Frank in general, and then that law in particular. Do you think that was a good, product of bipartisanship, and is there more room for bipartisanship like that with regards to Dodd-Frank?
So that's taking us a little bit far afield from our topic, but if someone, in the spirit of every time I said I was going to moderate on the Community Reinvestment Act, many people said to me, oh yes, that's the thing that caused the financial crisis. In response to that. So if there is, a 5-minute take you want to give on, if you have a bullet point on Dodd-Frank, you are welcome to give it, but I recognize that that's not the thing you came here to discuss.
Well, sure. I can give a little bit of an overview. Look, we regulate the banking industry in general for safety and soundness reasons. We have insured deposits to prevent runs. We have other restrictions, or prudential restrictions. I think those were viewed as somewhat deficient through the financial crisis. Dodd-Frank was enacted. There are debates on whether or not it was the right medicine for the disease, but be that as it may, it sort of pumped up what was the already existing regulatory sphere in a number of different ways, including the regulation of banks was created on a tiered asset schedule. So you had the up to $10 billion banks, the 10 to 50, and the above 50 were treated as the largest institutions. I think what we saw through the last law that just went through was that $50 billion mark was really a competitive barrier to entry. So you had the $3 trillion banks at the top, you had the $50 billion banks. That's about a 40 to 50 times difference that were bearing the same regulatory costs. So as a practical matter, that was a barrier to entry. And frankly, that's really, to me, one of the lessons we see a lot of, even as we talk about the CRA. There are a lot of laws enacted for presumably good purposes that quickly become used by industry as a means by which to protect their competitive advantage. And so the The thing about what they just did with increasing the 50 to 250, I think was a modest step in the right direction of allowing some more competition in the banking industry, allowing banks to build up scale without a punitive sort of cliff effect. And to me, again, that even as a person who's practiced in this area for 25 years, having become the regulator, and this is not something that really is Republican or Democrat. You think back to the Carter era, he was one of the biggest deregulators of certain industries, and you can see why, as you're sitting there, that certain things, as soon as they're put in place for safety and soundness or to protect a certain community, quickly become used as a means by which to prevent competition with potential competitors.
So go ahead.
I was just going to say, I can agree with a lot of what Keith said, and having been at the Consumer Financial Protection Bureau, one of the things financial regulation is hard. And one of the things you really are worried about is the law of unintended consequences. It is very difficult with fast-moving industry to set these rules and not have them boomerang around on you. And just to connect the discussion about Dodd-Frank with our topic today, the Community Reinvestment Act, I think some of the dynamics that I've been trying to highlight, I think, are what gave rise to the Dodd-Frank Act, where there really was a concern in Congress that the prudential regulators, they have to look out for the entire banking system and the profitability, the safety and soundness of the banking system. And so, consumer protection concerns took a back seat. And some of these dynamics I've been talking about, like the idea of rent-a-bank, that you have competition among banks for their charters, and that ends up having federal regulation protect against state-level regulation of predatory lending. It was that kind of thing that led Congress in part to pass the Dodd-Frank Act and to create a Consumer Financial Protection Bureau, where you consolidated consumer protection functions in one agency that had that as its highest mission. Unfortunately, the CRA wasn't really touched by this process, and so the CRA is still in the hands of prudential regulators. And the fear I have about this whole modernization process is that, once again, that concerns for bank profitability will take priority over some of the consumer protection concerns that really should be front and center.
Bert?
Well, I think one of the things to, again, somewhat repeat what's been said is Dodd-Frank was passed in the aftermath of a very severe crisis. It's typical of legislations passed in crisis situations. There's an overreaction, and so what we've had with the recent legislation is an attempt to try and eliminate some of the worst of the excesses of Dodd-Frank and to try and strike a better balance. Whether we have or not, it won't be known for several years or after the next crisis. I thought we had another question. Someone had a question?
We do.
Actually, before, if I could, I think the organizing principle executed more successfully in some places than in others around Dodd-Frank was assuring as financial companies engage in transactions that there is a mutuality of interest inherent in those transactions. And so, I think Alan Greenspan said, he was invited to testify, he said his thinking about the free market had been challenged, that there had been irrational exuberance, that he never believed that companies would do things, I'm paraphrasing here, as stupid as they did because the market would correct for it, they would be punished. He said his thinking had been challenged around that space. And so, while it seems, sort of maybe a no-brainer, should we have to pass a law that says that when you make a mortgage loan, the person you're making the loan to has the ability to repay, that you need to verify that? Should we be able to do that? What happened was many of the people making mortgage loans didn't have any type of share in the ultimate risk of what was happening with that loan. right? And so when I say mutuality of interest, part of this is making sure that when you have companies engaging in a space, they don't just get to pass along all of the risk to someone else, that there is legal risk, that there is capital risk built into the system. And I think many of the rules that we passed, the qualified mortgage rule, the qualified residential mortgage rule, the fiduciary duty rule, which has been rolled back. I mean, the fact that investment advisors don't have a fiduciary duty to their client, which is to say that they can make investment advice to a client that might be more in their interest than in the interest of the client, is sort of appalling. And that was what the fiduciary duty rule was all about. It was rolled back by the administration. So this principle of risk sharing, of ensuring a mutuality of interest, we may disagree about the mechanisms to do that. I hope we can agree that that's inherently a good goal, however. And again, I would say you don't have to take my word for it. There are people, in this space for a long time, Alan Greenspan, who said that his thinking was challenged by what happened in the financial crisis. That you did see things happen that sort of belie a notion, some fundamental market theories that you would expect in terms of how this all plays out. And when you have that ability to pass the risk along the line to someone else and not have to pay the consequence for it, I would argue you do have to put in place many of the core provisions of Dodd-Frank, and some of which, by the way, just promote transparency around what's happening in markets, more data. One of the industry's biggest complaints has been around the database that the CFPB collects around consumer complaints. It's data. And I'm sorry, but I think it's somewhat hypocritical to argue against it.
Sort of like the CRA, we should have a clear metric, right?
There you go.
No, I didn't say clear metric at all. And by the way, let me just say, we're not opposed to metrics. We're not opposed to metrics within CRA. In fact, while there aren't clear metrics, there are a series of metrics that banking examiners use and metrics that people assume are the case. We're not opposed to metrics. We just don't believe you can have one metric, and we think that the system for coming up with metrics has to be, on the MSA level, it has to involve the community, and it can't be set in stone.
Should there be a safe harbor?
A safe harbor for what?
To have credit, so if you're outstanding or satisfactory, you can't, the regulators can't hold up your transaction for a CRA protest.
So Keith's talking about a merger or an acquisition. I think an interesting thing about that is people have assumed, so in a merger review, you have to do a CRA review, you have to look at their record of serving the community. By the way, 98% of banks get a passing grade on CRA. And so I will tell you that when an outstanding bank applies to merge, that application goes faster than when a satisfactory one does. And of course, at various periods of time, there's been a limitation on banks acquiring another bank if they have a failing grade that needs to improve or a substantial noncompliance. So I would argue that while there's not a safe harbor, there is today a system in which banks with an outstanding record have a much easier time getting their merger through than banks that do not. But CRA is not the only applicable law. In fact, much of what advocates have used recently can be found within the Bank Holding Company Act, the public interest and antitrust provisions built into not just banking law, but all of corporate law. And those, I think, are really the more meaningful questions. So when we look at whether or not a transaction will produce a public benefit as it is legally required to, and you look at the record, Daniel Tarullo, Federal Reserve Board Governor Daniel Tarullo, said there has been very little evidence in research that consolidation within the banking industry has produced a public benefit in the form of lower pricing, benefits to consumers, that if anything, you do see overall an anti-competitive effect of consolidation within the banking industry. These are the forward, prospective-looking aspects of the law that consumer advocates have questioned. They have said, when you apply to merge, you ought to show that your merger is going to produce benefits for the public writ large, and specifically for those communities among us that have been least well served. So no, I don't think that there should be a safe harbor. Should an institution with an outstanding record have an easier time of it? Yes, and they do. I think if you look at the average number of days of an institution with an outstanding acquiring another institution, that it's less than one with a satisfactory. And by the way, if you look at how banks prepare for a merger, in every other aspect of how they prepare for a merger, the due diligence is significant. It lasts months and months, and they spend a lot of time doing it. Not so with CRA. Make it clear what they need to do in advance, and they will do it.
Okay, we've had someone who wants to ask a question waiting patiently. So please introduce yourself.
All right, Dan McLaughlin from National Review. It seems to me that conceptually, at least, that CRA is really, it's a bundling statute. It really is saying that essentially, if you want to do, in a simplified way, if you want to do upmarket lending, you have to do downmarket lending. And I guess the two conceptual questions I have about that are, one, is that too much of a spur to gigantism in the industry? And secondly, why do we think that down market lending markets should be served or have to be served by banks that are also in, an upmarket lending business?
I think that's an excellent question. And I think that this is where this has come up is in terms of banks that have been chartered to serve minority communities. At one time in this country, we had a lot of banks in Cleveland, where I grew up, and other places that would focus on serving, neighborhoods, ethnic communities. We used to have a lot of small S&Ls that would do that, as well as credit unions. And I think one of the things that's happened, and I think it's unfortunate, is a loss of a lot of these small independent institutions, in part because they couldn't handle they couldn't deal with the competition, the subsidized competition coming from large banks that were trying to meet their CRA obligations. And I think that's been one of the unintended but unfortunate consequences of the CRA.
Any response over there? No?
I would just say, CRA is a law that essentially says that you can't just lend to the well-heeled. And there's a whole history around that, and that is the nature of the law, that it says that you can't just pick and choose to lend to wealthier people. You can't just pick and choose to lend to just white people. That's, there's other aspects of the law, and I think that those measures are appropriate. Look, there is some aspect of CRA and the suite of civil rights laws that we have, which is a corrective not just to ensuring that there's not ongoing discrimination in credit markets, but also a corrective to our history. And so the history is important. The history is not just relevant in terms of what happened then, but it's relevant in terms of what happens today. So when you start life with relatively little accumulated wealth, right? And African Americans in this country have 7 cents on the dollar for accumulated wealth. White people have a lot more accumulated wealth. When you start with relatively accumulated wealth, you're more likely to default on credit obligations. So your credit score is more likely to be lower. Well, when you have a history in which certain communities were denied access to credit, were denied access to the means to build wealth, you have an ongoing impact. 75% of redline neighborhoods today still economically distressed. It has an ongoing impact. So it is a corrective for both things, for making sure institutions don't discriminate today in who they choose to lend to, and two, for a history of discrimination.
All right, we have another question.
Yeah, as I understand it, originally the CRA was just focused on preventing discrimination, and then in the 1990s it kind of mutated a little bit into looking at outcomes and looking at how many loans were actually made to certain economic groups, as opposed to focusing on instances where loans were denied to people because of their ethnicity or other factors. And I'd like to get your view on whether this change is really a good one, or whether you think, to what extent you think that could have contributed to the problems we had 10 years ago when people who shouldn't have gotten loans got loans, in part because banks were pushed to making loans to meet those quotas. And to the extent the CRA is now being looked at again, if any changes would be in order to make sure that it really sticks to its original goal of avoiding discrimination as opposed to pushing loans to be made to people who then later may not be able to handle them?
I think that's an excellent question, and I think it gets at something I've been trying to say, which is I think at the time that the law was passed, Congress and policymakers really were not worried as much about the dangers of extensions of credit, right? At the time, it was the concern was simply just the classic redlining model, and so I think the way that consumer credit worked back in 1977, it made sense simply to think about ensuring that people served minority communities and underserved communities. But I think now as part of the conversation, and I mean, I'm not one of those people who thinks that this had the unintended effect of contributing to the crisis. But I do think that now part of the conversation should be and has to be, are we incentivizing the extension of credit to minority and poor communities where that extension of credit is going to harm them, right? We can't, I don't think it makes sense, given in the wake of the crisis and given the debate we're having about predatory lending, to not make that part of the CRA calculus. And I think it's something that regulators are having to deal with anyway. There's a debate now about what the tolerances should be. The Consumer Financial Protection Bureau had a payday lending regulation that would have had these small dollar lenders ask questions about the ability of borrowers to repay. Who knows what the fate of that rule will be. I think it's being rolled back. But there's a broader conversation anyway that's going on and that has to go on about what the guideposts are going to be. And I think it would be very strange to modernize the CRA and not have that conversation as part of CRA modernization, because otherwise you're just acting on the same assumption from the 70s that we know is no longer true.
I'd like to point out, though, that even before the CRA was enacted, there were several laws that had been enacted to bar lending discrimination explicitly. The Fair Housing Act, Consumer Protection Credit Act, Equal Credit Opportunity Act, and HMDA. So laws were on the books, which is why I would question that as to whether CRA was really intended to deal with lending discrimination for the first time.
I'm going to agree with Bert here. The law was always, yeah, I know. Thank you. The language of the law is that it imposes a continuing and affirmative obligation on deposit-taking institutions to serve the credit needs of the communities in which they're based, consistent with safe and sound operations, written right into the law, a prohibition against pushing institutions to make loans that somehow affected their bottom line. And so really that word affirmative really meant not that you are prohibited from doing bad things, but that you must do good things, that you must serve certain segments of the communities that are underserved. And so no, the basis just sort of, on the question, no, it was not established fundamentally as a prohibition against discrimination, even though that was part of the rationale. I said it was a suite of laws because there were a number of laws passed addressing different aspects of that problem. You really can't think of it's just CRA or it's just HMDA or it's just a COA. These things were passed as part of a broad concept. CRA specifically is this affirmative obligation. And I want to correct another thing. It's not quotas, though it might become quotas. CRA does not say you must make a certain number of loans to low and moderate income people. What it sets up is an examination procedure to examine how well you're doing at that. And it compares Bank A to, say, the rest of the market in that place. And if Bank A is making a lot less loans to low and moderate income people in a particular place than banks B, C, D, and F, Bank A might get a lower grade. It fundamentally is not quotas. The metric-driven system being proposed by the OCC right now would establish quotas. And that's why I pointed out at the beginning that, interestingly enough, we're in an interesting time. Historically, that idea has been one attacked by conservatives. The Clinton administration proposed a metric-driven approach to assessment areas by MSA, and it was withdrawn because of outright opposition by the banking industry and opposition by conservative economists. And so it's just interesting that we're now in a place where I'm telling you the proposal would establish quotas. You ought to be concerned about credit allocation. You ought to be concerned about how you establish the right number. And I think there are other ways less detrimental to establishing clarity for what counts and what doesn't.
Keith, do you want to respond?
Well, look, I mean, I think I think your question actually puts a finger on sort of some of the reason we're up here, right? I mean, we have a law that was enacted, maybe just expressing views of Congress in a suite of laws. So. This particular law was meant to address an issue of geography at a time when there were banks located in communities and banks may not be lending to part of that community. It has morphed over time, even with the aiding and abetting of Congress at times, into something else with regulators clearly establishing a regulatory framework that bears little resemblance to what the original law and its obligations were, and now we're here, and what do we do now? And I think you have to kind of go back to basics. How does this, what does this law do? How does it operate? In many ways, is it a tax on valuable economic transactions? If it's a tax, then maybe we should just make an explicit tax through a series of clear metrics and quotas. I don't know the answers to these questions, but I mean I think that's what we're grappling at the moment and asking those questions. So maybe you take something that was sort of dark and murky and had perverse effects like the ones that Bert was talking about and others potentially, and you make it explicit. And if people don't like that, then you can, follow it up through some further change through the democratic process. I do worry, one of my big worries we haven't really talked about is the phenomenon of disintermediation, right? I mean, so you're basically, if this is a tax, it's one of the taxes on the banking industry that's basically pushing stuff out of the banking industry. And it's not just payday lenders and the like. There are other ways to make commercial loans and get capital to good borrowers that don't have to go through this, very clunky and costly regulated industry. And, over time, that will decrease the safety and soundness of the industry.
I mean, this is where shadow banking essentially comes from. And the roots of the last crisis were in shadow banking, and arguably the roots of the next crisis will be in shadow banking.
Okay, do we have another question?
Rob Chatfield from Free to Choose Network. I did bank M&A in the early 2000s, and Jesse, there may not be quotas, but there's de facto quotas when you're doing M&A. If you didn't hit a mark that somebody wanted to, there was no timeline with regards to when your acquisition was going to be approved on. That said, you touched on something earlier, though, Jesse, which I think the panel's danced around, which is you have nonprofit credit unions, which essentially their charter is to go ahead and serve these underserved communities, if you will, and yet they're not subject to CRA. And I'm actually okay with that because that's what their charter is supposed to be. But why would you want to expand upon this and say, oh, if it's not really working with the banking, we're going to go ahead and expand this over to these ones over here?
I guess I would start by sort of talking about whether or not it's working in banking. I think the evidence is, in fact, as I suggested earlier, in terms of the impact, that it is working, that it's having an effect. Frankly, I don't think we would be sitting here having this conversation if it weren't. I don't think it's just, by the way, again, you don't just have to trust my word for it. I think if you talk to bank CEOs, if you talk to the banks, they would say it's a really important law, and the banking industry has largely come to a consensus. We don't want to do away with it. We find value in it. I think it does motivate institutions to do some things that they otherwise wouldn't. I think it addresses some market failures, and I think there may not be total agreement on that, but I think that there is actually some agreement on that. I don't know that you have to apply CRA to credit unions. I agree with you. Their mission and purpose is to serve people of modest means. That's why they were established. But I don't believe that they're doing, all of them as an industry, a very good job of fulfilling that purpose. And so I think if you look at the data, the evidence would suggest that many of the largest ones are not serving low and moderate income people and people of color as they should be. And that is the reason we support applying CRA to credit unions.
I think a lot of banks would agree with that too, to level the playing field between the credit unions and the banks. And maybe, and again, I'm of the theory that we ought to have a fundamental rethink of CRA, but it ought to be evenly applied across all deposit-taking institutions, because credit unions, as a practical matter, you really can't differentiate from banks today, with one exception, that is they don't pay income taxes.
Well, as we're drawing to a close here, it sounds to me like there's broad consensus that we need to do something about the CRA. So if each of you had a wish list and you can get one item, you only get to pick one thing. So you get one item on your wish list. Well, let's take Deepak's off the table by giving him what he wants, by saying, Congress is going to, well, give Bert too. Congress will repeal the act, and now you get to put one thing in the new law. What do you want? What's the most important thing we need to do?
Don't start with me. I have to go first all the time.
Okay, fair enough. Bert.
Why me? No, again, I think you have to, in this day and age where technology is, I think you have to question the need for a CRA or anything like it. I think that the key thing is to have an efficient financial services sector where all the players are on the same, playing on the same field, and that includes the credit unions. And then let the market work it out. Because again, as I said before, I think one of the problems of the CRA is it has actually lessened diversity among financial services providers because of the one-size-must-fit-all rules it has. And I think that we've got too much homogeneity in the delivery of financial services, and I think CRA contributes to it. So I'll continue to say we ought to repeal the law and then rethink what it is, if anything, that's needed.
So I'll take the question as assuming that we will replace the law with something like the CRA, and it'll have a scoring system. So the question to me is, what should that look like to respond to all of the changes that have happened over the past 40 years? And as I've been saying, I mean, I think the biggest change is a recognition that consumer credit can cut both ways. It gets people their cars, their houses, their educations. It's an incredible force for good in our society, but it can also wreck families. It can also kick people out of their homes. It can also destroy communities. So it's a very powerful force. And the law, when it was passed, did not recognize the degree to which the extension of credit could cut both ways, could both serve minority communities and underserved communities and also wreck those communities. And so what I would want is a scoring system that takes that into account and that assesses not just extension of credit to low-income and minority communities, but also the effects on the community of that extension of credit. And so if you have banks that are really doing the right thing and are providing good alternatives for people that need small dollar loans to keep up with their bills and get ahead, then those banks ought to get credit for that. And if, on the other hand, they're using their banking charters to shield and to give immunity to what are in effect, the modern day equivalent of loan sharking happening through financial institutions, that ought to count against them. That's very simple, and I think there would be broad public support for that kind of approach, and it could all be done within something like the existing CRA framework.
I was going to go last.
You could be last. All right, Jesse.
Well, if I could have one thing, it might be to go back and tell the people who wanted to repeal it that maybe AML, BSA would be a higher priority in terms of lessening the load on community-based institutions. But I think, in designing the law, obviously what we want is affirmative obligation across industries that is measurable, but I would point out that quantitative factors are data too that can be measured, that has some level of transparency and accountability, and that is responsive to local needs, that is based and grounded in serving the community.
And so, look, for me, I mean, I kind of go back and forth as well on the standardized versus individualized type of obligation. To me, as I think about it in the history of this, and I actually did a short piece on this in 2000, which we pulled out for my thing, and remarkably little had changed since then. But one thing that always occurred to me is when they put out the last rules in the early 90s, there was something for a strategic plan where a bank could sort of tailor-make its own CRA initiatives. But to me, the lost opportunity there of the regulators is they wouldn't then guarantee that if you met your plan, you were, going to, achieve a certain rating under the CRA or get certain number of safe harbor. And so I can understand, having been a regulator, there's some difficulty with that and having to measure the strategic plan. But I still think, even as we sit here today and discuss these issues, it's a little bit of a lost opportunity that the goal, if you go back again to first principles, is to make sure the bank is focused on its community, that it's lending to its community. Why don't we let it, design its own plan? And if it's, meets the sort of acceptability criteria, we let them go off and do it. And, they basically are able to achieve their own purposes. We check on whether they're cheating or not on their own plan, and then that's it. We move on and we hope that encourages economically beneficial transactions. Because I do somewhat worry the more we commoditize this, the more we focus on lending in certain geographies that become designated as certain areas. I mean, you see the effect on it, as Jesse said, but I'm not sure that's a good thing, right? Because everyone's competing for loans there. They get de-designated, they move somewhere else. It needs to be a little bit more, again, about getting banks involved in their communities. Banks will have different conceptions of what communities are based on the nature of the bank that they are.
Keith, I think, makes a very important point, and that is what the definition of the community is. It's easy to think of community in a geographic sense because it's physical, you can define boundaries and so forth. But in fact, society, particularly a large society like this country has lots of overlapping communities and lots of different communities of interest. And unfortunately, in my opinion, the CRA doesn't recognize that.
Well, since Bert jumped in, I will say one thing. I'm
So much for my last word.
I'm going to agree with Keith. I'm going to agree with Keith here to an extent. I think the problem, Bert, with your comment is that the community is actually statutorily defined. I think there's an issue here. And by the way, has a clear intent and history within the law. You try to redefine community, I think you have real problems. But I will say on the strategic plan, I agree. Banking, I've often said, look, there's a metric-based system right now. It's called the strategic plan. People don't use it because it's viewed to be sort of a hassle to get it approved. And also, I think the factor you talked about, there's not a guarantee if you hit the number. What community groups would want would be a guarantee that if you don't hit the number, then you don't pass. And the bankers I talk to want it both ways. They want both performance contexts. Okay, if the economy goes bad or something happens, that's a reason, it's a really good reason why we couldn't hit the number, then we could still pass. So they want it to only cut that way, and I think to be fair, it has to cut both ways. If you hit the number, you're guaranteed to pass. If you don't hit the number, you're guaranteed to fail. And so if you want to have clarity, then you can't say it's clarity, but we can move the goalposts if it's advantageous to us. But we won't move the goalposts if it's disadvantageous to us. That's not a position of integrity. I think there's a lot of hypocrisy within that. And if we could agree on that, by the way, I think community organizations would say, okay, we have some concerns about how you set the numbers and how you get the plan approved. But as long as it cuts both ways and we can live by that, we'd be okay with that aspect.
Jesse, hit the number sounds like quotas.
It is quotas. I made that point earlier. I mean, look, this was originally proposed by the Clinton administration, and it was withdrawn because of opposition from conservatives and from banks. It's now what's on the table. It's interesting that we're debating it now under the Trump administration, under a Republican. And I'm not, again, we're not opposed to metrics and quotas. We have some issues with how you get there.
Quotas don't have a good history.
All right, well, I think we have just about exhausted our time. I thank all of our panelists, and please welcome them and thank them. Join me in thanking them.